Welcome to Alpha Insights. I'm Kristen. Today, we're digging into a pragmatic moment in tech, monetization moves, some surprising research on how AI changes work, and more consolidation in sensors. With me is Drew, our tech sector analyst. Hey, Drew. Glad to have you on. And listeners, remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Kristen. Great to be here.
Let's start with OpenAI. They began testing ads inside ChatGPT for logged-in adult users on the free and paid basic tiers in the United States. Walk us through what that means and why investors should care.
Sure, the short version is this is a clear push to monetize broad access. OpenAI says ads won't change the answers ChatGPT gives, and they'll avoid showing ads on sensitive topics like health or politics. For investors, it's significant because it signals a revenue path that doesn't require charging everyone or gating access behind high-price subscriptions. That can scale ad dollars if users accept it.
Sounds promising, but are there risks?
Definitely. User reaction matters a lot. Any perception that ads are interrupting trust or skewing answers can trigger pushback. Remember previous experiments that drew criticism for placement and relevance. Regulators are watching targeted ad practices, especially in AI apps where personalization can be powerful and opaque. So watch two things: user retention and any ad revenue metrics OpenAI publishes, and also regulatory signals around ad targeting in AI.
Good to know. Now, switching gears, Harvard Business Review ran an 8-month study at a tech firm and found AI tools sped people up, but actually increase the amount of work, not reduce it. That feels counterintuitive. Explain what's going on and why investors should care.
It's not that surprising once you think about it. AI tools let employees do tasks faster and expand the range of things they can handle. That often leads to people taking on more work or more complex tasks rather than companies cutting headcount. For investors, it changes the ROI story for enterprise AI. If boards expect AI to automatically yield labor cost cuts, they might be disappointed. Companies need to measure value differently. Look for output, quality improvements, new revenue enablement, not just time saved.
So, when you're evaluating corporate AI bets, what should you be asking management?
Ask for granular KPIs. How are they measuring task mix, output per employee, quality metrics, and whether AI is enabling new services or higher throughput? Are there explicit headcount plans tied to deployments, or is management focused on capability expansion? The more transparent they are about those metrics, the less likely investors are to be surprised when savings don't materialize the way they expect.
Makes sense. Another item? Ouster agreed to buy Stereolabs. The deal includes $35 million in cash, plus 1.8 million shares. What's the strategic logic there?
Ouster makes LiDAR, and Stereolabs brings advanced stereo vision. Combining the two creates a more complete sensing stack for robotics and autonomous systems. For OEMs and fleet operators, buying a more integrated sensor solution can simplify procurement and integration. Strategically, this is consolidation in the sensing layer, which we've been expecting as the market matures.
And what should investors watch after the deal closes?
Watch how they integrate product roadmaps, whether they can cross-sell into existing customers, and the timeline for a combined offering to hit revenue. Integration risk is real. Cultural fit, engineering alignment, and go-to-market coordination will determine if the deal actually accelerates adoption.
Quick hits before we wrap. Toyota unveiled an in-house game engine called Fluorite for vehicle interfaces, and there were a bunch of consumer XR and accessory reviews. What's the investor angle there?
Automakers pushing their own engines for in-cabin UX is about controlling the user experience and capturing more software value over time. Good UX can drive aftermarket revenue, higher retention, and licensing opportunities. For consumer hardware, steady product improvements and strong reviews help sustain device demand, which matters for companies that supply components, software, and services in that ecosystem.
All right, Drew. Before we sign off, give listeners the practical watch list. What should investors keep an eye on in the next few months?
3 practical things. 1. Monitor user and regulatory reaction to OpenAI's ad tests and any ad revenue or retention numbers they disclose. 2. When you see enterprise AI rollouts, ask for the specific KPIs I mentioned. Time saved is only part of the story. And 3. Track M&A and partnerships in sensors and automotive software for signs that integration is translating into customer wins and revenue.
Great. Let's finish with a quick summary. What are the top takeaways for our listeners?
Sure, first, OpenAI's ad test is an important monetization step, but user trust and regulation could quickly shape how successful it is. Second, AI often changes the nature of work rather than simply cutting workload, so expect more nuanced ROI conversations at companies. Third, sensor consolidation and in-cabin software moves indicate firms that can integrate tech and show clear monetization plans will be in a stronger position.
Perfect. If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Thanks for listening, and thanks, Drew.
Thanks, Kristen. Talk to you all next time.